Everyone around me was selling. The phones were ringing, the screens were red. Men who had spent 30 years in markets were making decisions in 30 seconds. Fear has a sound. I have heard it many times. It sounds like urgency dressed as reason. And I was buying. Not because I was fearless. I want to be very clear about that. I felt everything they felt, the same uncertainty, the same weight of not knowing where the bottom was. But somewhere beneath that fear, there was something else. There was a question no one else was stopping to ask. What does this crash actually mean? And for whom does it create the opportunity they cannot yet see? That question is the difference between panic and preparation. And today, I want to walk you through exactly how I learned to ask it. The year was 1992, September, and the British pound was under siege. For months, the signals had been building, quietly, the way pressure always builds before something breaks. The European exchange rate mechanism had locked European currencies together at fixed rates. It was an elegant idea on paper, but markets do not live on paper. They live in reality. And the reality was this: Britain's economy was too weak to sustain the rate at which the pound had been pegged. The British government knew it. The traders knew it. But knowing something and acting on it are two entirely different things. Most institutions hesitated. There was reputation to consider. There were relationships with governments. There were legal structures, committees, risk departments, all asking the same question: what if we're wrong? I asked a different question. What if we're right and we don't act? That distinction sounds small. It is not small. It is everything. We built a position, quietly, methodically, $10 billion short on the pound. Not in a day, over weeks, each step deliberate, each calculation tested. And on September 16th, the day history would call Black Wednesday, the British government raised interest rates twice in a single day, trying to defend the currency. First to 12%, then to 15%. It did not work. By evening, they withdrew from the mechanism entirely. The pound collapsed. We made nearly $1 billion in a single day. But I do not tell you this story to impress you. I tell you this because that trade was not born in September. It was born in the months before, in the stillness, in the analysis, in the willingness to sit with a thesis while the rest of the world called it fantasy. Crashes do not create opportunity. They reveal opportunity that was always there. The preparation happened long before the panic. When markets crash, the noise becomes deafening. Everyone speaks at once. The television fills with experts. The headlines multiply. And inside all of that noise, something very specific is happening that most people miss entirely. Prices become wrong. Not slightly wrong, catastrophically wrong. Because human beings, when frightened, do not sell what is overvalued. They sell what they can. And in doing so, they create distortions, pockets of deep mispricing that have nothing to do with the underlying reality of what they are selling. I have watched quality assets sold at Depression-era prices, not because they were worth less, but because the person holding them needed cash, needed comfort, needed to feel like they were doing something. This
is the mechanism. Understand it clearly. A crash is not a verdict, it is a vote, and votes taken in panic are almost always wrong in their extremity. The market is not a weighing machine during a crash, it is a confessional, and frightened people confess more than they should. Now, this does not mean you buy blindly into falling prices. That is not the lesson. The lesson is that you must have already formed your view before the crash arrives, because when it comes, you will have no time to think. You will only have time to act on preparation you either did or did not do. Before the next market dislocation, ask not, why is this falling? Ask whether this fall is logical or emotional. The answer will tell you whether you are watching destruction or opportunity. Remember that. My theory of reflexivity is, at its core, a very simple observation dressed in complex clothing. Markets do not reflect reality. Markets shape reality, and reality, in turn, shapes markets. It is a loop, a feedback mechanism, and once you see it, you cannot unsee it. Here is how this plays out in a crash. Prices begin to fall, perhaps for legitimate reasons, an economic contraction, a currency misalignment, a debt crisis. It does not matter the cause. What matters is what happens next. Falling prices cause fear. Fear causes selling. Selling causes more falling prices, which causes more fear. The loop accelerates. But here is what the crowd forgets in the downward spiral. The loop runs in both directions. At some point, and this point is never announced, it is never obvious, it arrives without ceremony. The selling exhausts itself. The weakest hands have sold. The most frightened participants have exited. And what is left is a market that has overcorrected so severely that the reflexive loop has no choice but to reverse. Prices begin to stabilize, then rise slightly. Then confidence returns, cautiously at first, then with momentum. Buying begets buying. The same mechanism that drove the crash now drives the recovery. The crowd that creates the bottom also creates the bounce. You only need to be positioned before they realize it. The 2008 financial crisis, the 2020 pandemic collapse, the dot-com crash of 2000, every single one of them followed this architecture. Down with violence, recovery with momentum. And the investors who understood reflexivity, who recognized the feedback loop and positioned accordingly, were there when the loop reversed. During the next crash, do not ask, when will this end? Ask, what is driving the feedback loop and what would cause it to reverse? Follow that question and you will be closer to the answer than any analyst on television. Sit with that for a moment. This is the principle that separates everything. It is easy to talk about buying in crashes. It sounds bold. It sounds intelligent. It's the thing people say at dinner parties and in financial seminars. Buy when there is blood in the streets. A fine phrase, completely useless without the one thing it never mentions. You must still be standing when the blood appears. I have watched extraordinarily intelligent people, people who understood markets deeply, who saw opportunities clearly, lose everything in a crash because they were already over-leveraged before it arrived. Their analysis was correct. Their timing was irrelevant because they had no capital left to act on what they understood. This is the tragedy that repeats itself in every single market crisis without exception. In 1997, during the Asian financial crisis, entire institutions with decades of expertise were destroyed, not because they were wrong about the long-term trajectory, but because they could not survive the short-term devastation. They were right eventually. They simply did not exist by the time eventually arrived. My rule, the rule I have held through every crisis I have navigated, is this: the primary objective of any position is not profit, it is survival. Profit is what happens when you are still present as the cycle completes. The greatest trade in history